Are you interested in starting with dividend growth investing but don't know where to begin? Are you looking to create passive income through your investment portfolio? Or are you looking for new ideas to build out your existing holdings? In this video, I will be breaking down the benefits of dividend growth investing, how to set up your portfolio, and some ideas on what to look for to get your dividend portfolio up and running based on your age and investment style. Hi, my name is Jeremy, and welcome back to the Dividend Stockpile channel. Here we talk about dividends, passive income, option selling, and financial freedom. Please subscribe to the channel if those topics appeal to you. So when starting out with dividend investing, it can be hard to know what companies to start with. There are thousands to choose from, not to mention exchange-traded funds or ETFs, and closed-end funds, CEFs too. With this in mind, I have created the Dividend Growth Investing Starter Packs to help identify ideas of sample portfolios that you can start from. Remember, you'll need to do your own research to determine if they're the right fit, but these are companies and funds that I either own or have done extensive research on and believe they can be a good fit for most investors. The starter packs are broken down by individual stocks or ETFs and CEFs based on the current age of the investor and or the timeline until an investor needs to use the funds. So we're going to show 4 starter packs, one for a 25-year-old or someone who has 35 years to go before they need the money, a 35-year-old with 25 years to go, 45 years old with 15 years to go, or someone who's 55 and has about 5 years to go. So before we get into the starter packs themselves, I wanted to do a quick summary of why you might want to be a dividend growth investor. As a reminder, dividends are cash paid from company profits to you as the owner of a company. Just like if you had your own business and you had profit at the end of the year, you might pay yourself. Dividend payments are similar, but on a public company. The great thing about that is you don't have to sell your shares for income. You can receive the dividend and still maintain your portfolio balance. After all, cash flow pays the bills, not capital appreciation. While capital appreciation of your investment account is nice, at the end of the day, income and cash is what pays the bills. In addition to paying the bills, dividends paid out compound over time. If you don't need the money right now, you can use those dividends to reinvest in more shares, therefore compounding the returns and the amount of income you receive over time for free. In addition to that, companies also raise their dividend payments consistently over time. There are multiple companies that have been raising their dividends consistently for over 100 years. So if you find the right companies and stick with them long term, they will reward you by raising their dividend payments without you having to do anything. And as you'll see, dividends provide stability in turbulent times. It might be nice to see the high-flying growth names, but there are reversions to the means and growth may not always be in style, but dividends provide a steady path up over time to help provide stability to your portfolio. The power of dividends cannot be understated. Looking at this example from the Hartford funds, a $10,000 investment in the S&P 500 without reinvesting your dividends would come up to about $641,000 after this time period, which is still a great return. But by collecting those dividends and reinvesting them back into the S&P 500, your portfolio would go from $10,000 to over $4 million. That is a huge difference, and dividends made the difference and are very important to the overall total returns of your portfolio. And remember, the S&P 500 not all of the companies pay dividends. So if you have a portfolio strictly of dividend payers, the result might even be more significant. In addition to providing better returns, they beat out the non-dividend payers over time as well. So there's another review by the Hartford funds showed that over a time period of 1973 to 2022, $100 invested in dividend non-payers, so companies who do not pay a dividend, would have gone up almost 7 times to $694. But dividend payers would be worth $8,060, and dividend growers, which is what we look for in dividend growth investing, will be over $13,000. So again, dividends have provided better returns over time than even an S&P 500 or non-dividend payers. So it's important to establish proper diversification in your portfolio when you're setting it up. Most common advice recommends at least 20 to 25 stocks from different industries for diversification. Getting to that number early in your investing career can seem overwhelming. So in today's video, I picked 10 stocks for each age group as a starting point, and you can add additional holdings over time. ETFs are also a good place to start. You only need a couple, and it gives you easy diversification without a lot of the background research that you would need to do for individual companies. Looking at this chart here on the page, it shows a good breakdown of the math behind the number of stocks owned. Your choice of current dividend and dividend growth should be based on your timeline of when you will use the funds. In a previous video, I've explained this concept in detail, and it's showing on the top of your screen right now. In short, the longer your timeline until you need to use the dividends, the lower the starting yield can be, and the higher the dividend growth should be. Dividend growth will outpace the higher starting dividend over time. We should all have a plan for our investments. Our timeline, goals, income needs, risk tolerance, risk capacity, and diversification requirement should be taken into account. With that, you have to look at your overall portfolio to understand what type of investment choices you can make. So today we're going to be talking about stock investments, but you can also consider bonds, cash, real estate, precious metals, alternatives, and even crypto as types of investments you can focus on. And maybe there can be a little bit of all of these in your portfolio. But in addition to having stocks in your portfolio, you also have to look at the location and size of the investments you're making. So you can have domestic growth, small companies, value companies, large growth, foreign value. The list goes on and on. So you need to make a determination at a certain point where you want to focus, and you can focus on a little bit of each of these. But in today's video, we're only going to focus on getting started, and you can grow your account over time and find more diversification through these different investment types, location, and size of the companies. You can also look at different sectors of the economy to invest in. There are 10 major investing sectors listed here: telecoms, utilities, energy, consumer staples, and so on. So even within your stock portfolio, you should look at these different sectors to become properly diversified. So I've provided picks for each of the age groups and time remaining, so you can tailor your approach to where you are in your investing journey. Please remember that this is just a sample portfolio and may not fit your needs or risk tolerance. Individual due diligence is required before any purchase is made. Additionally, valuation should be considered because even a great company can be a bad investment if bought at the wrong time, when the price is higher than the fundamentals of the company can justify. Another option is to buy in over time through what's called dollar cost averaging, where you buy a set amount each week or month, no matter what the price is, so you can average your cost over time. So with that, let's work through the first starter pack. And again, this is for a 25-year-old or someone who has about 35 years to go before needing to use the funds. So as I mentioned earlier, I picked 10 individual stocks that I feel would be a good representative sample of how to start a portfolio for someone who has a long time frame. The names you see here are most likely familiar to most people through our everyday life. But if you look on the top of the list, it shows the ticker. This is what you can search the company by, the company name, what industry or sector they're a part of, current price as the time of the recording, how much they pay in dividend, what their dividend percentage yield is, how many years of dividend growth have they had, and their 5-year dividend growth rate. When you have a long time to go or you're really young in your investment career, you're going to want a dividend growth rate that can grow over time and beat inflation and grow your account. So it's a very important thing to focus on. I also included the 5-year average total return. So this is the price appreciation over time with you may invest in the dividends. And again, as dividend investors, we're not primarily focused on the capital appreciation that happens in the account, but it is nice to see, and it will make you your account balances higher over time. So looking at these 10 companies, we have Microsoft, United Health Group, American Tower, which builds and maintains cell phone towers, Visa, the credit card processing company, Lowe's, the home improvement retailer, ASML, which works in semiconductors and chips. One you may not have heard of is Broadridge Financial Solutions. And they're financial, and what they do is all the behind the scenes work for stock investing. So they send out the statements, they send out the annual reports, they send out the voting, all those types of things. Alimentation Couche-Tard is a Canadian company, and the name is a little funky, but you'll probably know them best by that they are the parent company of the Circle K convenience stores, Broadcom, and Costco. Most people in the United States and around the world have heard of Costco, and I bet many of you have Costco memberships. Overall, these companies, when combined at equal weight, will give you a current dividend yield of 1.38% with a 5-year dividend growth rate of 17.62%. So this is an excellent place to start your portfolio if you have a long time frame. Moving on to ETFs and CEFs as a possible investor starting pack for younger investors or people who have a long time frame. And so I picked 3 ETFs for this portfolio and provided different percent allocation for each one of those, as you'll see in the blue highlighted section. So the 3 ETFs that I would choose for this age group would be SCHD, the Schwab US Dividend ETF, DGRO, the iShares Core Dividend Growth ETF, and OMFL, which is the Invesco Russell 1000 Dynamic Multi-Factor ETF. So these ETFs will provide broad diversification because each of these funds holds hundreds, if not thousands, of investments within them. So instead of having to pick individual companies, you can buy an ETF and get that instant diversification and professional management or index that they follow, so you don't have to worry about researching each individual company and staying up with the specifics. So I would recommend a 40% allocation to SCHD, 20% to DGRO, and 40% to OMFL. And based on those weights, the total weighted dividend yield of this portfolio would be 2.43%, and the 5-year growth rate would be just over 13%. So again, this is a very solid way to get broad exposure to growing dividend investments over time. Moving on to our starter pack number 2. This is for 35-year-olds or people who have 25 years to go before they need the funds. And so at this point, we're going to start increasing the current dividend and lowering the dividend growth rate because you have less time until you need the money. So individual stocks, same basic principle, pick 10 investments that you can invest in or consider, and that shows the details of how much in dividends they pay, the dividend yield today, how many years of dividend growth, and the growth rate. So in this particular one, I picked ABBV or ABV, BIPC, which is Brookfield Infrastructure, Tractor Supply, TSCO, BLK, BlackRock, PEP for PepsiCo, JPM, JP Morgan Chase, NEE for NextEra Energy, ADC, which is Agri Realty Corporation, and they invest in freestanding buildings for retail tenants. We have LMT, Lockheed Martin, and GLW, which is Corning Incorporated. They do a lot of glasswork for technology companies like cell phones and things like that. So because our time frame is a little bit shorter, our average dividend yield has gone up from the previous example, and currently it's at 3.22% with a little bit over 11% dividend growth rate. So this gives you a good balance of current yield, plus it continues to provide the dividend growth that you're going to need to beat out inflation and grow your accounts over time. And our ETF and closed-end fund portfolio for our 35-year-old is very similar. We still have SCHD, DGRO. We've also included something with a little bit higher yield through BST, which is the BlackRock Science and Technology Trust. This is a closed-end fund that invests in technology-related companies. I would recommend an allocation of 40% to SCHD, 30% to DGRO, and 30% to BST. With those combinations, the current yield would be 4.81%, and the growth rate would be 11.65%. Again, providing a solid current dividend and still getting that growth over time. Our next starter pack is for our 45-year-olds or people who have 15 years to go before they need to use the dividends. Individual stocks, we're starting to get a little bit higher dividend yield and a little bit lower of a growth rate. Remember, you don't have a lot of time left until you need the money, so you want to get that income now with a little bit of growth in the future. And so for this starter pack for individual stocks, I would pick Chevron Corporation, CVX, Toronto Dominion Bank, TD, Realty Income Corp, O, Altria Group, MO, Manulife Financial, MFC, Southern Company, which is utility, SO, Merck & Company, MRK in the healthcare space, Texas Instruments, TXM in technology, Johnson & Johnson, ticker JNJ, and Target Corporation, ticker TGT. Looking at the overall dividend percentage today, it would be 4.40 starting yield with a 7.7% dividend growth rate. Again, you're looking for that higher current income because you want to accumulate that income quicker because your timeline is getting shorter, but you still want that growth that will beat out inflation over time. Looking at the ETF and CEF portfolio for a 45-year-old, we're going to continue with SCHD, the Schwab US Dividend Equity ETF. We're going to introduce a new closed-end fund, is BDJ, it's the BlackRock Enhanced Equity Dividend Trust, and that invests in dividend payers, but also has an options overlay that they use to increase the yield. And we're going to introduce JEPQ, or the JP Morgan NASDAQ Equity Premium ETF. This is a fund that invests in technology companies and the NASDAQ 100, and also writes options on it to enhance the yield. I would recommend a portfolio of 40% SCHD, 30% BDJ, and 30% JEPQ. With those weights, the current yield is 7.08% with a growth rate of 6.84%. This is an excellent place to be if your timeline is shorter because you're getting a substantial current yield and you're still getting that dividend growth that you're going to need to grow your account and beat off inflation over time. And last, we have our starter pack number 4, and these are for people who are already 55 years old or have a 5-year time frame before they need to use the money. So at this point, we're not looking for as much growth, we're looking for more current income. And so the dividend starter packs are reflective of that. So individual stocks, you're going to start seeing a little bit more high yield. You're going to go with more of these stable payers and like utilities and financials and real estate. They're a little bit more stable and pay a higher dividend. So this sample portfolio for 55 years old, I would recommend Duke Energy, DUK, WP Carey, WPC, Cogent Communications Holdings, CCOI, Main Street Capital, MAIN, Prudential Financial, PRU, Bristol Myers Squibb, BMY, Beachy Properties, VICI, and they own a lot of the real estate in Las Vegas and elsewhere around the country. A United Parcel Service, UPS, Clearway Energy, CWEN, which is a green-focused renewable energy utility company, and T. Rowe Price Group, TROW. With an equal weight, the current yield of the dividend is 5.15% with a 7.32% dividend growth rate. Again, we're looking for a higher yield and a little bit of growth going forward. This will provide that current income that you need because you only have about 5 years to go until you need to use the money. You don't have time to wait for the 1%ers or the 0.5%ers that we talked about in the 25-year-old group to grow over time because your timeline is shorter. So you need that current yield now. And looking at the ETFs or CEFs portfolio that I would recommend to take a look at for your people who are 55 or have a short time frame to go would be to continue to invest in the SCHD because the dividend growth rate is so strong with this company and it provides broad diversification. I would also include JEPI, JEPI, which is JP Morgan Equity Premium Income ETF. It's very similar to JEPQ that we talked about earlier, but this is a little bit more stable because they invest in S&P 500 companies as opposed to NASDAQ 100 companies. So you get a slightly lower dividend yield, because there's not as much risk in this particular portfolio of companies that they manage, but you also get the more stability that you would need when you don't have much time frame left to go. Also want to introduce a closed-end fund called UTG, which is a Reeves Utility Income Fund. And this fund invests in utilities across the country, and also utilize an options overlay to increase the yield. Looking at that combined portfolio of ETFs and CEFs, the current dividend yield would be 7.57% with a dividend growth rate of 3.59%. Again, because your timeline is short, you want that current income now. So this provides a very heavy income flow of 7.57%, but still over time will provide a dividend growth rate that will meet or beat inflation over time. So in conclusion, I wanted to talk about how dividend growth investing can be a great path to financial freedom for anyone at any age. Whether you're 25 or 55, there's a portfolio that would work for you in dividend growth investing. That being said, the earlier you start, the easier it will be, meaning the less money that you have to invest yourself, and the more your investments will grow over time without you having to do any of the heavy lifting. Always look for a balance between dividend yield and dividend growth based on your timeline. And please remember that I am not a financial advisor. You have to do your own due diligence on these investments or any other investing before you invest any of your hard-earned dollars. We really appreciate you watching. Thank you. Please subscribe if you haven't. If you want further information, you can visit us at dividendstockpile.com or reach out to us on X at divstockpile. Really appreciate your time, and while you're here, please take a look at the next video popping up on your screen. Thank you and have a great day.